Hi guys, I'm Ahmad Hanif from IPMI's Executive MBA class of September 2021, and on this video I'm going to give you a walkthrough over a cup of coffee on our corporate finance class taught by Professor Roy Sembel. So let's dive right in. So first of all, in corporate finance there are two perspectives. One is the outside-in perspective and the second is the inside-out perspective. So first of all, the outside-in perspective talks about managing investments. So here there are two parts to it. First of all is doing the practical approach and the second is doing a theoretical approach. So obviously these two approaches depends on whether you use an active investing approach, which is by analyzing the companies you want to invest in, or if you're just a passive investor where you just go with the flow, invest in what other people are investing in what people are currently talking about. So first of all, on the theoretical approach, there are a couple of things we can do here. First of all is analyzing the time value of money, doing risk-return trade-off analysis, as well as analyzing the financial as well as technical aspects of that particular stock. And then there's also we can also do efficient frontier analysis using Sharpe ratio as well as Trainer ratio as well, and also Jensen's alpha. That's more on the theoretical side. And on the practical side, we did a book review, which I'm going to share the link in the description down below, titled A Beginner's Guide to the Stock Market by Matthew Kratter. Now the second side is the inside-out approach, which is more on managing the company. So first of all, when we talk about managing companies and in relation to investments, good companies don't always translate to good investments. Why is that? Because there's not only the aspect about generating profits, but also the value creation. So Ram Charan, he's one of the leading thought leaders in finance from India. He gives 5 criteria to determine whether a company is creating value or not. And first of all is definitely cash. That's the first criteria. The second criteria is margins. How good are they performing? Velocity. And then the fourth, that's the third aspect. The fifth is growth, and then the fifth is customer focus. So if a company has these 5 characteristics, then we can say that this company is definitely creating value, not only creating revenue or creating cash flows, but they're also creating value for the customer. And these companies would definitely be more appreciated in the job market. More appreciated in the stock market. Okay, so onto the context of financial management. The main objective here is to orchestrate in an optimal manner of internal and external resources. So there are 8 items that we'd want to manage in financial management. First is the capital structure. Second is the working capital. The third is the asset structure. The fourth is the revenue management. Fifth is cost management. Sixth is managing the cash flow. Seventh is managing growth. And the eighth is managing revenue. So there are a couple of challenges here. First of all, there are 4 main challenges here. First is principal agent problems, where the goals of the managers and the goal of the investors might not be aligned. This is because conflicts of interest, asymmetric information, as well as moral hazards. The second challenge is corporate governance, and then obviously stakeholder conflict of interest, and then the fourth is ethical behavior. So we can address principal agent problems by using 5 main approaches, which we can abbreviate into TARIF. So that's transparency, accountability, responsibility, independency, and fairness. Okay, so in class we also talked about managing assets and liabilities as well as investments. So there are 2 parts to it here. First is capital budgeting. We can do that through a couple of ways. The simplest of which is payback period, but there are a few caveats to it. So instead of payback period, it would be best to use NPV, net present value, as well as IRR to determine how to allocate capital into projects. So those two, NPV and IRR, they give a better measure of how to allocate a company's capital, either in mutually exclusive projects or in several simultaneous projects. The second aspect here is, aside from capital budgeting, is finance is managing the capital structure. And here, Modigliani Miller has a interesting theory they call the irrelevance of capital structure. Some people might, at a glance, it might be best to have things 100% within equity, whereas actually by using debt, the company can gain more leverage, as well as there are potential tax savings that can be realized if a company uses debt compared to equity. So that was among the things we discussed in class. We also covered some interesting topics. First of all, fraud, wherever it may be, either in investments or in company settings. And there is actually a fraud triangle. So there are three aspects that inhibit, that push fraud, that can be thought of pushing fraud to happen. First of all is obviously the opportunity, and then the second is the pressure, either internal pressure or social pressure, and the third is the rationalization. So these are the three key levers for fraud, which we as managers need to keep an eye on and minimize the chances of these happenings. We also talked about ethics, and then we also talked about the sustainability for finance value creation. As we know, sustainability is an interesting topic nowadays because people are getting more and more aware of the importance of doing business not only in a way that is profitable but also in a sustainable manner. And then we also talked about capital and corporate restructuring, mostly through leveraged buyouts, which is one of the most common ways for companies to do M&As, mergers and acquisitions. And for LBOs, what happens is a company purchases another company using a considerable amount of debt. So if things go right, it can be a success. But if things go wrong, then the newly formed company will have to assume lots of debt and will face considerable risks. And LBOs is something that's quite common in the sports arena nowadays. Like we've seen Liverpool be purchased using an LBO scheme. AS Roma was also purchased using an LBO scheme. So the discussion in class was pretty relevant to a couple of topics that I find myself interested in. And the source of value creation in an LBO is, among others, by creating value by dismantling conglomerate discounts. So think about it. If a company has several products, and analysts might have challenges in valuing all of the products or all of the subsidiaries equally. So the sum of the value might be lower than the valuation of each of the company's parts or subsidiaries. And finally, we also talked about international finance. We talked about foreign exchange, futures, and options tradings as well. And we also had the chance to do an event analysis. Me and my group, we did an analysis of Cemindo Gemilang's IPO, and I'll also share the link in the description down below. So that's that, a mind map and a walkthrough of the discussions we had in Professor Roy's corporate finance class from November until January 2021. It covered the span of almost 10 weeks with several weeks of holidays in between. And it was really helpful for me, a non-finance guy, to get a better grasp of corporate finance. I highly recommend that class. So thanks and see you guys. Bye.